My name is Era, and I'm the host of the Tamil Creator Podcast. I chat with creators from all over the world to share their stories and discuss hot topics in a way that I hope inspires, educates, and entertains you. Hello, everyone, and welcome to another episode of the Tamil Creator. I'm very excited about today's guest. I think he was my first interview when I reached out for like a written interview for tamilculture.com, but interesting, how I met Jay. And so our guest for today is Jay Vasantharajah. And the way I found it was so random. I follow a couple of newsletters, and in one of them, his tweet got featured. And obviously when I saw his last name, I was like, this guy's got to be Tamil. So I reached out cold, and he responded, and we've kind of developed a relationship. So that's kind of how we're here today. So Jay is a Toronto-based entrepreneur and investor, very low-key guy, but he's doing a lot of like amazing things. He's the founder of Atlastview Equity, and they buy cash flowing software and asset light / tech enabled businesses. So he's like trying to build the next Constellation. Maybe I'm wrong, but it sounds like that. And very Warren Buffett like. So Jay, thank you for jumping on the podcast, and excited to have you here.
Thanks for the intro, and thanks for having me, Ara.
For me, when I chat with like interesting folks like yourself, I start at the beginning because I think things, and especially I think we're both fathers too, so it's more of a curiosity question, just how your childhood or your formative teenage years, like how did that play a part in you developing a strong interest in kind of business, investing, entrepreneurship?
It's a great question. I come from a family of kind of small businesses. My dad had run a number of different small businesses, generating money and kind of building wealth for our family. And that played a role, but I think maybe a little bit later on, like it kind of sit in my subconscious for a while. I saw him grind, work long hours, kind of build something from nothing, provide for our family, and just kind of being able to see that as a possible kind of career path. That kind of sit in my subconscious for a while, because I went down the regular kind of route of going to school, getting a degree, going into the corporate world, and so and I didn't really become interested in business and investing till a little bit later in my. I mean, I guess it's all relative, but I didn't really take an interest into it probably until about my fourth year of university, when I stumbled upon Warren Buffett, Charlie Munger. I read The Intelligent Investor and really got into like value investing, and Peter Lynch as well. Peter Lynch was a mutual fund manager of at Fidelity, and he had a crazy track record. And he's wrote some really good books too, and it kind of resonated with me. And but I still went into kind of the corporate world and into Deloitte, in their Toronto office there, in their consulting division, and so I think like watching my dad kind of build these businesses had always kind of stayed in the back of my head, like, hey, it's possible that you can actually kind of build something and build a business, and that is your career path. That's a possibility, as opposed to kind of going down the kind of the corporate, working your way up the corporate ladder and all that kind of stuff. And so had it have not been for my dad, seeing him do these things that might seem extraordinary for people that have never seen businesses being built from the ground up, made a huge impact on my life and career. And so that kind of how during my formative years, your question kind of during my teenage and formative years, that had a huge impact on how my career progressed to this date.
Yeah, that's interesting. I like the answer you kind of gave around the subconscious part, was because I think of my story as you're talking. It seems like it's quite similar, where like my dad had like a restaurant, he had like a convenience store in different parts. And I think it's not like he told me, he actually didn't want me to go into business, because he's like, being an entrepreneur is hard. I don't want that for you, but I ended up obviously doing it. But I think just thinking back to his experiences, I think what I saw was, I saw him and my mom, because she helped in like the businesses as well, just work super hard, not really complain too much. I saw the freedom and flexibility obviously came at a cost. Like, it's not free. I learned some good things and I learned some bad things, in terms of, I don't know if your parents were the same way, but I've seen like, certain people in terms of when they run businesses, they make some money, but then it's like, they don't allocate it well, or they don't like invest it well. And, they're kind of stuck in like continuing on this business, versus like, I guess we have that platform that our parents gave us to kind of get a bit more information about all right, when we start a business, how can we exit from the business? What are the options that we have? So yeah, it's like subconsciously I just kind of saw that, and I think over time, I don't know, for whatever reason, I gravitated towards it as well. So thanks for sharing that. You talked about, taking the typical path. I think you worked at Deloitte for a little while before you kind of became a full-time investor. What did you do in school? And then I guess, while you're working at Deloitte, how did you, start thinking about, hey, more seriously about like investing? Because for me, I'm a big believer in like the fire movement, and like I think, working in the startup grind, whether it's my own or like working at other like folks, like my focus has always been like time as the most valuable resource versus like money, and that's kind of what made me think about investing. And so just curious about your thoughts.
Maybe I'll walk back towards university days. So in school, I earned a Bachelor of Commerce degree. I got into accounting because it seemed like the natural thing to learn at the time, and because I didn't know exactly what type of industry I wanted to go into, and didn't really know like exactly where in the business world I'll be. But I figured that if I kind of understood accounting really well, which is kind of the language of business, I do well no matter kind of which way I decide to go in the future. And so I did the whole CPA route. At the time, it was called the CA, Chartered Accountant. But during school, it's funny, I actually kind of had a little bit of like a side hustle going. I learned how to kind of do HTML and CSS, and started building websites. A lot of them were like WordPress websites for various organizations at the university. So like little student clubs and student societies, and even had some like private clients. I got an accounting firm that I built a website for, and so it had a little kind of side hustle going while I was at university in my third and fourth year. But that kind of came to a grinding halt as I accepted an offer from Deloitte, and it was in their Toronto office. So it was really exciting because I got to move to the city downtown, kind of live the city life. I grew up in the suburbs, and so it was a pretty large change for me, but super exciting change as well. And as I was working at Deloitte, within about a couple years, I knew that I I liked what I was doing. Don't get me wrong. I enjoyed the people I was working with at Deloitte, but I knew that I wanted to kind of start something, and I wanted to do it earlier than later. I knew at that point, the longer I kind of hold off on quitting and starting a business, the harder it's going to get, and more commitments you'll have, and the more used to a job and a salary you get. So I figured, I got really nothing to lose at this point. And I saved up some money. On the weekends, I drive cabs for my dad, who ran a fleet of taxis and out of kind of our hometown. And so like I'd work at Deloitte during the week, and I'd go home on weekends and drive cabs to earn more money, and that way I have and earn more money to put towards a business or investments and so on and so forth. And that way I had a bit more of a cash buffer to carry me along after I quit my job. So I quit my job 2013, 2014, somewhere around there. And then started my first business, which was called Client Flows, a consulting. It was an agency. Basically, what we did was run marketing and sales campaigns for a number of different clients. Started off kind of working with more smaller businesses, but then eventually we scaled up to work with very large companies. We did, everything from, we developed apps for our clients. We managed paid media campaigns. We managed email campaigns, search engine campaigns. We did the whole thing, basically generating demand for a roster of clients that we worked with. We worked with a lot of tech-enabled businesses, software, worked with a lot of medical device companies. We had a pretty wide-ranging kind of portfolio of clients. I ran that for about half a decade. And several of my clients had really large successes. Like I saw one of my clients, while we were kind of running their campaigns, had a $450 million IPO. Another one of our clients got acquired for $2 billion. We had a few clients that raised a bit of capital, went through the whole, venture capital route, Y Combinator, Series A, all that kind of stuff. And kind of seeing this, I realized like I'm kind of in the wrong business here. I mean, earning consulting fees is nice, but it's hard to scale, right? It's you're scaling kind of human resources, human capital, which is kind of always has it's a bit of a bottleneck. And I thought to myself, I'm like, my true passion lies in investing, and wouldn't it be nice to kind of actually own own some of these companies or a piece of these companies or the entire company while doing a lot of the same kind of consulting playbook, agency playbook on companies, so I can actually capture a lot of the upside. Throughout this time, I was building a bit of a real estate portfolio here in the GTA as well. I stayed very close to the markets, followed the stock market, had a stock portfolio going, and followed a number of different companies. And so like I knew my true kind of passion really was investing and managing investments. So kind of combining the two. So combining the passion for investing and managing kind of money and the operational expertise that kind of built up working with these through my agency client flow, working with a lot of these clients. I kind of developed a thesis around buyouts, so buying software tech-enabled companies, running the playbook for adding value, which we can get into and later on if you like, kind of what we do at Atlasview. And that's how we kind of launched Atlasview. And we came together with a thesis, raised a bit of capital, and we're kind of off and away. Done a couple transactions here. And so now I'm kind of in the position where a lot of the years of kind of working with clients, developing that operational muscle, as well as making investments, taking risks, allocating money to various asset classes, really help kind of carve the thesis here and help build Atlasview Equity to what it's become today. And so it was kind of a transition. So kind of from school, accountant / consultant, to running my own consulting business, to being like a full-time investor and private equity manager.
I'm curious about, you mentioned a couple, you mentioned kind of two of the, I guess, outside successes of your client base. When you're doing this consulting company, Client Flow, how did you get these companies as your customers?
Good question. It's just like how really any sales process works. A lot of calls, a lot of meetings, referrals, networks. A lot of these customers kind of came in through other customers as well, so we get referred to from one to another, and one thing would lead to another, and we land larger and larger contracts. And so it's just like any other sales process, really. It's just picking up the phone, doing proposals, talking with your network, talking with your clients. I always say your clients are always kind of I would say the clients are always the best source of your highest quality leads, right? Because you're coming through a warm referral, you're a lot more likely to close on better terms.
Love it. Okay. You had this great post that I reference a lot, or I think about because, and it's advice when people ask as well. I reference that article, and I think you talked about why the importance of kind of getting to the first $100,000 to start investing. You talk about, just what some of the things you mentioned, like you worked at Deloitte, you were kind of driving cabs on the weekend, and these are things I don't think a lot of people are willing to do, and I love the fact that you're willing to hustle, scratch whatever you needed to do to get that number. Just out of curiosity, I read the article, so I want to allow you, because I feel like you'll tell it better, why that particular number is a good starting point to get into investing.
It's a very arbitrary number, and truthfully, I only picked 100K because I mean, one is relatable to my story, but two is because it's a famous Charlie Munger quote. I'm sure you've seen it around. It's basically like, you got to haul ass for your first 100K. After that, you could take the foot off the pedal a little bit. So the actual number doesn't, it varies, right? And it's probably a bit more than 100K today if you account for inflation and cost of living and all that kind of stuff. But I mean, let's say it's in the range of like 100 to like 500K or somewhere around there, right? Where you want to have that kind of money aside. And the logic is basically you want to have escape velocity in your kind of your investments or your assets that you own. And what I mean by that is, so let's say you have zero assets, right? And so the only assets you're going to be able to put aside is, say if let's say you're fully employed, you're working a full-time job, you got to take money after taxes and put it aside to invest in something, right? That sucks because that takes away from your actual enjoyment of living, right? So let's say if you make like 100K a year after taxes, let's just say it's like 70K, and then if you gotta you want to put aside like 30, right, or like 20K, that's 20K you could have spent on like whatever, but you got to kind of build that first nest egg. Once you reach a point of escape velocity, so you put money away into say the stock market, real estate, whatever investment that'll compound and grow over time. you get to a point where your assets that you own appreciate more than whatever amount you can save, right? So like if you had, let's say, you hauled ass, you saved every penny, you put it away, and you got to a point where you had like 300K in assets, and just kind of for ballpark number, let's say you put that into the S&P 500, maybe a portfolio of like REITs or the NASDAQ, and on average you're generating about 10% return per year, over a long period of time. Obviously it's never a smooth 10%, but on average, right, say if you had 300K in assets, 10%, you're technically saving 30K that year without actually putting away any money and avoiding the tax man, right? Which is a huge impediment to building wealth. And so, like, so the difference between your assets appreciating 30K versus you having to take out 30K from your after-tax salary to put it away is huge, right? And so eventually that number will become 500K, then maybe eventually a million, 10 years down the line, you'll have maybe a million and change in assets. And at that point, you're saving like, 100K per year without literally actually doing anything, which that means it kind of maximizes your, like if you're still, earning a salary or business income or whatever it might be, you can use more of that money to actually enjoy your life while your assets technically save for you. And then eventually you'll get to a point where, if you have some investments that, where part of the return is cash flow, part of the return is appreciation, the cash flow will actually pay for a large expenditure. It's large amount of your personal expenditure, if not all of it, right? And so that's a really good position to be in. So like the point of the kind of the quote, original quote from Charlie Munger, and then my kind of iteration of it is basically, you want to hustle, grind until you can get enough assets where you reach investment or savings escape velocity, where you're saving technically each year without actually putting money away, just because your assets appreciation. And two is the cash flow aspect of it too. I mean, if some of the returns come from cash flow, dividends, rental income, whatever it might be, paying for a large amount of your personal expenses, you're at a point where your investments will kind of keep compounding and you won't run out of money, which I think is kind of the basic concept behind the FIRE movement that you had mentioned earlier. I'm not an expert on the thing. I'm kind of vaguely familiar with it, but it's kind of the similar concept. You want to kind of save a large enough nest egg that continues compounding and you won't run out of money, right? You'll keep kind of growing your wealth while living the lifestyle you want to live.
This episode is sponsored by nobody. That's right, nobody. So if you could be kind enough to hit that subscribe button, that would mean a lot to me. I like the escape velocity term, I guess, because of space and all, just escaping an orbit. I like that, because the orbit here is really your 9 to 5, like you're fixed in that until you're able to escape with, this money and investing and mentality you develop. I'm curious about investing because, obviously you've done this for a while. For most people, I think they overthink things and they don't, it's like if you want to get healthy, people are like, I got to go to the gym 5 days a week. But no, really, just start with going to the gym for 5 minutes. Uh,
Yeah.
and it's like, I feel like that's like my philosophy with investing, which is maybe I didn't know much about real estate investment or like crypto or like, stock market investing or like businesses. But I feel like if you dip your toes slowly, you put a little bit of money in it, you have a little bit of skin in the game, you're incentivized to learn about that thing. And then obviously as you learn more, you feel more confident about that investment. You could put more and more money into that. I don't know if that's something that you agree with, not agree with, but just as you're speaking, is just something that popped into mind when I speak to a lot of people, and I just say like I don't when I first do something, I don't know much about it, but I spend money or like I put a little bit of something into it. So I feel like I need to now recoup that cost or learn something in return for, putting in this money. So that's just how I feel.
I like that attitude, and I think that makes complete sense. The key really is consistency. I think you nailed it. You want to get into a habit of regularly investing, looking at investments, whatever it might be, but it's how consistent you can be over a very long period of time, right? And so it's not a race; it's a marathon, and you just need to get into a consistent habit.
Now I want to get to the meat of the matter, what we're here for, which is, Atlasview Equity. Been following, I follow your newsletter, I follow kind of Atlasview as well, and just kind of the updates there. So for, people listening that don't, we kind of briefly gave you an overview, but why don't you tell people what Atlasview Equity is, what kind of things, what kind of companies you guys look for, like what are some criteria of companies that you would consider purchasing, and we'll start there.
So Atlasview Equity, we're a private equity firm, meaning that we use both our money and investor money to buy companies, mostly software, but we also look at tech-enabled services as well and other sort of capital-like businesses. But our primary focus is definitely software. So criteria-wise, okay, so what do we look for? The strategy we take is generally what's called a buy and build in private equity, and so the what that means is we look to make one large platform investment into a specific industry, and then from there we'll make that platform will now acquire smaller add-ons and bolt-ons to grow inorganically over a 5-year period is our hold period, before we look to exit. What we look for is so, like I said, primarily software. We want to see that the software is sticky, has very loyal customers, has a degree of pricing power. You probably see me talk about pricing power a lot and how important it is for a business to have it. And just to kind of clarify, pricing power meaning being able to actually increase your prices year over year on your customers, so without losing many or any of them, and increasing it to an amount that far exceeds in inflation, right? So inflation is quite high these days, so it's a pretty high bar to begin with. And so we look for businesses with pricing power, low ongoing capital expenditures. So in software parlance, that means mature businesses. So like that the product needs to be stable. The product needs to be kind of well tenured, and no major kind of rewrites are required, or major kind of capital expenditures and R&D required. We see a lot of software companies competing in verticals that are, or like horizontal fields that are so competitive that you need to be investing in obscene amount of R&D every single year just to maintain parity with your competitors. And so we're not good at investing in those kind of businesses. It's kind of beyond our scope. We want to look at more mature, more verticalized businesses where the product is not changing massively year to year. It's basically pretty stable, kind of these boring niches, mundane niches that they power very critical functions for their customers, and very critical, they're mission critical, have pretty high switching costs for their customers, is typically what we look for in a software business. And then from there, a nice to have for us would be a great team. We don't mind having to rebuild a team. And in fact, a lot of the businesses we look at, so we're in the lower middle market, and the lower middle market means generally businesses under $50 million in enterprise value. And so a lot of these businesses that are under 50 million generally have missing headcount, missing executives. Like, you usually don't have a CFO. They might have an owner operator who's kind of like the head honcho CEO. They may have a second in command, maybe like a head of operations or whatever. But we'd like for a good team to come with the transaction, but we're okay if there's significant missing headcount. We're okay if the owner wants to transition out as well. We've done CEO kind of replacements and transitions. It's not a problem for us. But the core thing we look for is sticky customers. We want to know that your customers just they swear by your software product or your service you're offering. They're not going anywhere anytime soon, and the product is very, very stable.
Got it. And I know that you guys have completed 2 acquisitions. As a sales guy, you think about funnels and just activity at the beginning of the funnel. So on closing like 2 acquisitions, like how many companies did you have to meet with, or I guess deals did you have to look at before closing on 2?
Good question. So we have a pretty high bar, and high standards in what we look for, and we're okay with only doing maybe 1 acquisition per year. Just to kind of preface, like our kind of acquisition strategy, we wanna wait for the fat pitch, right? That's a term that Warren Buffett uses quite often, is the no-brainer deal where this is going to be a home run. And so we have a fairly high standard. And so for these 2, we probably looked somewhere in the range of maybe 150 to 200 deals. And it's like sales. Basically, they're leads, right? Like 150, 200 kind of leads come inbound. You qualify them. Maybe like, half of them might be qualified. And then from there, you meet with either the founder or potentially there's a broker involved, and you meet with the brokers and you kind of understand what, whether it's going to be a fit in terms of, your initial due diligence and, kind of understanding where the team, the motivations are, getting an understanding of their numbers, and you qualify them further from there. And you do your pitch too, right? I mean, like we're like it's competitive, right? Like we have competitors, like you mentioned earlier in the call at Constellation Software, but there's also a lot of private equity competitors in our arena as well that we compete against. And so at the same time, they're pitching us to business owners, and brokers are pitching the sale to us. We're pitching back to them saying this is why you should work with us. And it's almost like a demo, right? Like just like a software sale or any other sale. It's just where it's kind of like a two-way pitch. And then, if things look right, we might, we have a pretty quick turnaround. Like, as soon as we get the right data, we could pretty much have an answer within like 2 days, basically, whether this makes sense or not. And we'll send across like a high level, like indicative offer. It's like basically like a term sheet on how we kind of approach the valuation. And if that looks good, we go into the kind of like a 2-week period where we do a bit more due diligence before we send out what's called an LOI, letter of intent, and that's binding. So binding on the seller side, meaning they have to give us exclusivity for a period of time. It's usually around 60 days, so 2 months, for us to do the rest of the due diligence, get the capital together, raise the debt if there's debt needed, and close the transaction more or less, get the purchase agreement signed at the end of the day here. So it's a long process, right? So I mean, those I know that the number kind of seems low, like two acquisitions, but it's a combination of both our kind of high standard and that it is a very long sales cycle, right? So and I know, I'm sure for your business there as well, for Continue Care, like your sales cycles is probably very, very long as well, right? And so it takes a while to get the number of leads, to run the number of demos, meet with the decision makers, get the proposal out. It's no different from us too. It's multiply that sales cycle by like 2, and that's how long our sales cycle is.
Yeah, I've had customers that I'm closing like more recently that 5 years ago I started talking to. So I know about long sales cycles.
Yeah.
Uh, so persistence is the name of the game. I think of the question, you're talking about the fat pitch, the no-brainer like deck or opportunity that you see. For me, when I hear that, I'm like, okay, like if you identified it, why isn't somebody else also pouncing on this? Or like, is it because like you have a set of criteria that is unique and like a unique experience or viewpoint that allows you to identify these no-brainers to yourself, but maybe for others it's not so much of a no-brainer because of unique information or access or something that you have. Like, is that sound about right? Or like, because if it's such a no-brainer, like why didn't somebody else snap it up? Is what comes to mind for me.
That's a fantastic question, and trust me, it's a question we ask ourselves all the time. Like, why are we the lucky buyer when we're looking at a deal? Why did everybody else pass on this, right? Because we're the small guys and we're just getting started, right? And there's a lot more established players out there looking to buy businesses, and so like, why did we end up with this deal, kind of thing, right? So it's a great question. And I think there's a few ways to answer that. One is, different buyers see different angles in every deal, right? So all the people in front of us might have passed because they may not know something about that business that we may know just from seeing pattern recognition of other businesses that we see, or expertise in the businesses that we're already in, the industries that we're already in. So we may have some sort of informational edge that the other folks in the arena may or may not have, or there may be some sort of risk in that business that we understand well and can kind of manage the risk accordingly, or eliminate the risk post transaction after we buy the business pretty well. And so the first kind of answer to that is we may have an informational edge, right? And when we look at a business, the second part is the area that we play in is still pretty niche, right? And so like there's larger private equity firms, the middle market private equity firms that are kind of in like the hundreds of millions of dollars, and we're kind of in like the tens of millions, right? So we're kind of competing against. There are a lot of other buyers, but there's not that many of them, and a lot of them are actually small shops as well. And what ends up happening is sometimes, I've seen this happen a couple times during a process that we were involved. the other natural buyers, other PE firms like us, they get tied up on other deals, right? They're usually small shops as well, like maybe like 10 people or less, or 15 people or less. And if they're, if they have like they're working on 3 deals, 4 deals simultaneously, it could take out all the analysts and the partners to be able to bid, to be able to move forward on a deal. So it's kind of funny that bandwidth actually becomes an issue in this end of the market, right? It never happens in the large cap spaces, right? So like the large, massive private equity firms like Blackstone, and they have like infinite bandwidth, right? They'll never be like, oh yeah, we're too busy to pursue this deal. But in our end of the market, a lot of times, lower middle market private equity firms like Atlasview and our peers and whatnot, they end up becoming too busy to go forward on a deal. So we end up becoming the lucky buyer, being at the right place at the right time. The last piece of information, the piece of kind of reason why we end up winning deals over other potential suitors is a lot of times like we built relationships with founders too. So we get a lot of direct inquiries. And we get folks like yourself are with software businesses, and we've kind of kept in touch over the years. And we build that direct relationship where that level of trust is established, and it's a daunting task, right? I mean, like if you ever embarked on selling your business, it's just like so much like information, and it's usually a first time transaction for the owner, the founder. They don't not really sure what's going on, kind of thing. So having trust when you start that process with someone is really key. And so we've been in scenarios where the founders kind of come to us directly and said, hey Jay, love what you guys do, love the transparency you guys operate in, also align with your philosophy. Would you like to take a look and see what my business might be worth and whether you'd be interested in buying it? And they haven't been talking to anybody else, kind of thing, right? And so that happens from time to time as well. And so kind of those 3 ways are the ways that we kind of end up winning deals. But even then, we still always ask ourselves, like, why are we the lucky buyer? Why did we end up winning this opportunity over all the other smart buyers, more experienced buyers out there? It is always kind of a fear, but you got to be careful because you don't want to get too wrapped up into it, right? Like because you could basically these are small businesses we're looking at, and they all have problems, right? Every single small business on the outside looks nice and polished, but once you actually look in, they all have problems. They all have things they're missing, things held together by elastics, massive glaring risks, and all that kind of stuff. You could talk yourself out of buying any business. Like it's really easy to say, oh, there's no way, this is too risky. Everybody else passed. So you don't want to find yourself in a position. It's a delicate balance. You don't want to be finding yourself in a position and saying, oh, everyone else passed on this business, I'm going to pass on it too because they must be smarter than me, and I'm just not going to. Because if you have that kind of attitude, you'll never get a deal done, right? And so it is a delicate balance.
Yeah, I think of it like you're saying, because like somebody hearing your answer might be like it sounds like a bunch of fluff, but I think it's actually true, the relationship part, because I think of like real estate. There's so many transactions that happen, like why do some people that are smaller players versus bigger players that have a big name get deals? And I think it's like a number of things, like you said, like bandwidth, relationships. I think that's the biggest one. I think when, especially with the business, I'm thinking like as a business owner, if I'm selling my business from experience or like just, talking to people, I know that it can be a very challenging and time consuming process where you might think you're going to be able to sell your company, and then the buyer takes you on a wild ride, or like doesn't actually have the funds to close, or there's a host of reasons why something doesn't work out. It's when you're building a business, when you're running a business, it's one thing because it takes up a lot of mind and just resources to run a business. Then you have to think about selling your business. That's a separate process you have to run in conjunction or in parallel to this, running and selling your company at the same time, which is kind of paradoxical in a way.
Yeah.
So you don't want to do it too many times. So especially if you've gone through bad experiences, if someone like yourself or like there's other companies like you said, peers, where because everyone's going to tell you, hey, I'll close fast, or like we'll give you if we give you a number or an LOI, like we're going to actually close on it, versus like changing their mind later. As a business owner, personally, I'd want to hear, hey, give me a evaluation and stick to it. And number two, like, do you have the funds to close on it? And number three, will you ruin what I've built? Because, it depends on how you view your business, but like if you put in a lot of time, especially if it's your first business, a lot of time, sweat equity, all of that stuff. Yeah, you're getting chips off the table by selling, but if the person buying it is going to screw it up, that also ruins your reputation in a way that, you built something and you know that it was working well, and now this person or company took something and ruined it. So exactly what you said, I buy it. So just speaking out loud from a business owner point of view, everything you made sense makes sense. Now, thinking from a sales perspective, the pipeline, we kind of, talked about the end and like some of the middle, but right at the beginning, in terms of building up the actual pipeline of like, you talked about relationships and all this, I guess two things. I know you also have like a personal newsletter, and, like you're quite active on Twitter. And then, like us, like, we meet in person, you spend quite a bit of time on phone calls or in-person meetings. It was interesting how you kind of structure your week. How much of your time every week do you spend on that front part of the funnel? And, how does your personal newsletter and Twitter feed into that?
Yeah, great questions. Okay, so how much of my time on the front part of the funnel? Quite a bit these days. I would probably say we probably spend about maybe 70% of our time looking at new opportunities, maybe 30% of our time managing, maybe 20% of our time managing existing portfolio companies, board meetings, all that kind of stuff, and maybe 80% actually chasing new opportunities. And a lot of those opportunities actually are for portfolio companies, right? They're add-on acquisitions for each of our portfolio companies, and so we're kind of regularly assessing potential add-ons as well. And so newsletter, it's been good to build an audience. It's been pretty much the best networking I've ever done. It's like basically leverage networking, right? Because then you can attract the people you want to, depending on the type of content you put out. You attract the people you want to meet, right? And so when you follow my newsletter, I believe, and I think you're on Twitter too, and so you'll see that my content's kind of pretty niche. It's around small business, it's around investing, buying businesses, things like that, right? And so as a result, I end up kind of meeting the right people through my newsletter, and my Twitter as well. Lots of people in lower middle market, private equity, lots of small business owners, lots of investors, capital partners that are kind of aligned with our strategy as well. In terms of kind of pipeline of deal flow, there really is no silver bullet. It's literally like any other sales process, right? You got your inbound leads and you got your outbound leads, right? So a colleague I work with, Ryan Kahn, who's a principal at Atlastview Equity, he runs our deal sourcing process, and so he's kind of the top of the funnel to the mid-range funnel, bringing deals to the investor committee for us to kind of review and either sign off on or turn down. We're pretty much on phone calls like around the clock, right? And so that's kind of our outbound process. Like we make outbound outreaches, cold calls, cold emails, talk directly to founders. We talk to a lot of brokers as well, a lot of kind of lower middle market investment bankers that are trying to sell a company, their client and whatnot, where we're speaking to many of those folks there. On the inbound side, like I mentioned, the newsletter and the Twitter following definitely helps. We get inbound leads, not a ton, not more. I definitely would like more for sure, but we definitely get like I get quality leads coming in a handful a month at least, and so it's definitely been super helpful. But it's been more kind of networking as well. Like I meet a lot of peers and a lot of other kind of business buyers through my Twitter following, my newsletters, and we kind of exchange notes like, hey, what are you paying for these type kind of businesses? Like how are you kind of managing a portfolio companies? What types of management systems are in place? Like what types of how are you structuring your deals? And like that, like talking with peers and kind of getting that kind of intel is super helpful. And I've pretty much met 100% of them right through Twitter and my newsletter, right? Like because I don't come from a general kind of private equity or finance background, right? And so it's not like I have a huge network that I've met through my regular work, my prior work, in kind of buying businesses and operating them, operating acquired businesses, and managing an LP money as well, like LP limited partner investor money, for those kind of unaware of kind of private equity terms. And so kind of meeting those peers through my newsletter and Twitter have been really, really helpful.
When you say you buy a company, it's like, I think of like buying real estate as well. It sounds like, oh, how do you just buy a company? So like in terms of financing, like similar to property, how do you actually get the funds to purchase a company? Is it like you're buying it in like all cash? Is there like some kind of financing? What are the different financing options? Did you know that every time you left a 5 out of 5 review for this podcast, a Tamil parent lets their child pursue a career in the creative arts? Okay, that's probably not true, But if there's a chance that it is, do you really want to jinx it? Leave a review. Do it for the young creative in you.
Yeah, definitely. So we have a core group of LPs, investors. They're kind of large fund of funds and family offices that kind of make up for a large chunk of the equity part. And we also use some debt as well. For most of our transactions, we try to close as much cash at close as possible. Unless there's something really strange or really kind of some sort of risk we need to mitigate in the business, like you could probably, a founder can expect somewhere around at least 80% cash at close, maybe even potentially 90%. And so the remainder generally is either a, we ask for either a seller note, so it's kind of a deferred payment over X amount of years or months or whatever it might be, or potentially a equity rollover. And that is a lot of founders actually find that attractive because they actually want to work with the private equity firm and get a second exit, right? So they get the first bite of the apple when we buy 90% of their business, and then they keep they reinvest the 10%. And so if a transaction has 50% debt, 50% equity, and they reinvest 10%, they actually end up owning 20% of the business, if just kind of math. And then they can have another large exit 5 years down the line, because we have our investors, fund of funds and family offices and all that kind of stuff, have a 5-year hold period, right? And so we need to kind of return capital in 5 years. What does that mean? We need to actually have another liquidity event 5 years down the line. So a founder that reinvests the money back into the company that they know very well and are in good hands with our kind of track record here. And so we roll that forward and we look to kind of get them another exit 5 years down. So that's kind of typically how we structure deals. We avoid earnouts. So earnouts, for those kind of unfamiliar, are their contingent payments based on the performance of the business. And a lot of private equity firms use earnouts. A lot of strategics, even strategic acquirers, so competitors or larger kind of companies, when they offer to acquire a business, they often embed an earnout, which in my opinion kind of annoying for both parties. Like it's yeah, it kind of de-risks the transaction from the buyer standpoint, but it gets complicated because you got to track the earnout, and then you risk like disagreements or disputes, which happens very frequently, right? Because if the earnout's based on revenue projections or EBITDA projections, like the founder might have disagreements on how exactly it's calculated, or how the company's being run, and they may not have control over that, how the company's being run, because after you sell control of the business, you're kind of at the mercy of the new buyer to basically make you that earnout, right? I mean, it's a small business, right? The people that run the business make a huge difference, right? It's not like you're buying like Google or Disney. Like you're buying like a small software company where like the 20 people, 30 people that are running the company make a massive difference, right? And so you're kind of at the mercy of the buyer. And so we avoid earnouts because we don't like complexity. We kind of want to keep it simple. Either we pay you most cash at close, and then kind of maybe a couple more payments down the line in a year, or you can reinvest some of your equity and we can kind of work together as partners, and we sell together in 5 years down the line. It's especially attractive for founders that actually want to stay on, because not all founders want to kind of sell and retire. A lot of founders we speak to actually want a capital partner to come on, buy the majority stake, and then keep working to get a second exit down the line. Maybe they need help in some of the areas that just aren't experts in, for example, M&A, right? And so let's say they've always wanted to acquire competitors, and they've always wanted to acquire suppliers or whatever it might be, adjacent businesses, but they didn't have the expertise to do it because it's a pretty complicated skill set. That's not, that's, you kind of need some experts involved. And number two is maybe they didn't have the capital to do it, right? Because obviously it requires raising both equity and debt to execute acquisitions. So a lot of founders say, hey, would love to partner with you as capital partner, and you help us kind of execute M&A, and we'll still kind of run the show and run the operations, and you come in and help us kind of acquire competitors and consolidate the industry a little bit. It's attractive because then founders that rolled over their equity own a big chunk of the business, right? And they'll have another exit down the line. And so that's kind of how we approach kind of structuring funding, cash at close, how much we kind of pay up front, how much we pay later. And at the end of the day, we want to be as founder friendly as possible, right? Like I'm a founder myself. I worked with founders my entire life. My dad's a small business owner. I totally get it. I can empathize. Like, this is your baby that you've built over X amount of years, and building a successful business, by the way, it's an incredible feat, right? Like, so many businesses don't go anywhere, they fail. They're not acquirable even. And so if you've got built a business that's a decent enterprise, and is people want to buy it, you should be very proud of yourself, right? It's not an easy feat. And we at Atlasview, we respect that. We respect founders. We want to give them the best offer possible, want to give them the best terms possible. And if they want to continue working with us, we want to make it as enjoyable as possible for them as well.
Yeah, just hearing you talk, I mean, this is part of your earlier conversation around like the newsletter and Twitter, just attracting the people and energy that you kind of want around you. Like for me, I can talk about this stuff all day. I'm like a business nerd. Like I love kind of getting into the weeds. I know maybe not everyone's like that. I don't think a lot of people are. So that's one thing. It's kind of attracting the energy. You talked about why founders would not necessarily want to just sell and just retire. Like I think about myself, which is for me, the attractiveness of selling is getting some chips off the table because it's like poker, right? Like until you actually cash out of the casino, like you can still lose everything, right? So just getting some money off the table, but having somebody, like you said, that can fill in the gaps, operationally, knowledge-wise, that can kind of, like you said, you get some risk kind of, off the table. You got some money for all the sweat equity you put in. And then, like you said, with somebody behind you, you can get a potential second exit. And that's happened
Yeah.
many times. I've talked to many founders that's actually happened. So that makes sense.
And it's funny, and we always ask, because I'm always curious, right? So some of these are pretty large check numbers, right? Like for the exit money that the founder will just get. They go from earning like kind of a salary or maybe some dividends, and all of a sudden it's just like a big cash liquidity event. And I always ask them, like, what do you plan to do? Like, just curious, what's your investment strategy? What do you plan to kind of do with that money, right? And some of them are okay, well, equities, bonds, whatever. And I always say, why not invest just a chunk of it back into the company that you know really well, right? And work with partners that you could trust, and work with us, and you'll have if you want to actually work in the business, like we could help facilitate as well. But as kind of like a portfolio allocation strategy, like let's say you put a chunk of that in stocks, ETFs, whatever, a chunk of that in like REITs or real estate, a chunk of that in like bonds. Why not put a small chunk in private equity, a company that you pretty much know like the back of your hand? You've run this business and you built it, so why not still own a piece of it, right? And so, that resonates well too, right? I mean, like you as a business owner, right? You obviously know your business really, really well, and that day will come when you want to sell your business, like and so why not keep like a chunk of it, and kind of capture some more upside down the road.
Yeah, and I think the other part of it is, you have an opportunity as a founder, I think, to alleviate yourself potentially. It depends on how you structure the deal, where all the things that maybe you had to do, but you didn't want to do is taking away time and focus. Like say it's like, operational stuff, or say you were really good and you enjoyed sales. Maybe now you can just focus exclusively on that. And that's kind of the biggest way to kind of, multiply yourself, and everything else kind of you can work with the acquirer to put something in place so that, hey, this is the best way to structure the company moving forward, so we can go from X number of dollars or this profitability to this much in like 2 years. So I think it's just like a real opportunity to kind of reset, because just like in any relationship or just dynamic, if you've been running a company with like a group of people and over time, it's like any relationship, like you need to maybe sometimes bring in new people, or just you need to exit that relationship as well. So that's one. And the conversation about earnouts, yeah, I completely agree, because I think about this example. I think even in the movie business, where a lot of stars get paid out based on like box office performance. And I think there was a case with I forgot who the actress was, but and there's just a lot of conversation around like you could gamify if you're the buyer, saying, hey, it's based on performance. But, say if it's on profit, you can gamify profit by padding the expenses so that, you don't have to pay somebody the money they're due, because you're just saying, hey, you know what? Instead of making $10 million in profit, you actually only made two, because they added a bunch of expenses that the person who sold their company has no control over, versus like something like revenue, or like, I don't know, some other number that's harder to kind of gamify. So
Yeah.
like you said, it's very tricky once you get into earnout. So it's ideal to avoid that as much as possible.
Yeah.
So completely agree. And something I want to get into is now that I guess the final part is you acquired this company. What's Atlasview's kind of playbook after you've acquired a company? Like, what do you do to help grow the company and like move forward towards exit or like maybe potentially holding the company? I don't know.
Yeah, great question. So we have a pretty well-defined playbook, and for those kind of interested in it as much detail as possible, we always try to put out as much of it on our blog, atlasview.substack.com, or just atlasview.com, just click on blog. And we try to be as transparent as possible on what we're going to do with the business post-acquisition. So the first thing we do in the first maybe 6 to 12 months is we focus on the operational part of the business, so what we call organic growth and organic initiatives. Generally speaking, most of these businesses have missing headcount. So when we're kind of underwriting our models, like, okay, so this business is cash flowing X amount, we actually decrease it in the first year because we got to hire folks. We got to hire, the platform needs to be very, very strong, right? So it needs to have a really good CEO if it doesn't already. It needs to have a really good CFO if it doesn't already. And these are software companies, so it needs to have a really good CTO if it doesn't already, right? And so it needs to have a good head of sales, a good head of marketing. And all those people cost a decent amount of money, right? And so when we are kind of putting together how much capital is required to buy a business, we take into consideration those headcounts, because generally speaking, as I mentioned, they're usually missing, right? For a small business, they're usually some missing headcounts around there. So kind of moving along the growth initiatives, so beyond hiring, we want to do best practices around kind of sales, marketing, implement the right strategies. We're a big fan of direct response marketing, and so things like search, email, SEO, direct outbound, to generate more top of the funnel. And it's as you probably know yourself, it's basically a math equation, right? So we have all the due diligence prior to the transaction. We could see how many leads that we're generating, how many of them are converting into demos, how many of those demos are converting into paying customers. We kind of know where things can be optimized, and kind of taking kind of to the next level. So that's kind of on the sales and marketing front. The next, which is my personal favorite front, is definitely the optimizing the cash flow of the business. And so there's just so many things in the business that you could do to optimize cash flow, and I talk about them quite frequently on both my personal blog and our Atlasview blog. Things like optimizing the cash conversion cycle, tightening your AR and the amount of invoices outstanding, stretching your accounts payable, not paying for a lot of things in advance. Like, we see so many software companies paying for like massive bills, like their hosting or Snowflake, or database, or like in advance, and in order to take advantage of like a 10% discount, right? And so just think about the cost of capital nowadays for a company like that, it's probably going to exceed 10%. Like we're looking to generate more than that, right, for the investments that we make. So it doesn't make sense to save 10% by paying an entire year's worth of bills up front, right? And so you might as well pay that over time and pay more, but have that cash necessary for us to execute on other initiatives where we'll earn more than 10% reinvesting that cash. And then finally, and this is also actually probably this is tied for my favorite as well, is price increases and price optimization. And what we found is that a lot of business owners, especially in the software space, right, the mission critical vertical niche software, they just don't exercise the pricing power that they have, right? Customers love their products, powers their business, but they've had the same pricing for the last like 5 years, despite inflation and all sorts of stuff going up. So we implement regular price increases as soon as we take hold. We usually do a bump right away, and then we do annual increases. Nothing too aggressive, but somewhere in the range of like 10% per year on an ongoing basis, usually baked into the contract. So if it's like a multi-year contract, we'll have escalators. We might even optimize the pricing, actually how the pricing tiers work, right? So sometimes the tier doesn't make sense. Like, we want to tie it to value. Like, how are the customers gaining value? Is it are they paying per user, paying per gigabytes of data? Are they paying for whatever it might be, right? Like, how are they using it? Like, how are the customers using the product, and how do we tie pricing to value so that it makes more sense? The people that are getting the most value out of the product are paying for more of the money, right? And so we optimize prices right away. It's one of the best ways to add value in a business. I've talked about it extensively on my blog. to increasing prices. And I've talked about it with you too, Ara. We've last time we got together that increasing prices year over year, it just makes it's a healthy business practice, right? It shows you which customers are how sticky your customers are and what the economic potential of those customers are. And realizing the maximum amount of economic potential of your customers is a very great thing, right? And so we spend the first year doing all those organic changes, right? So 6 to 12 months where all these things are get implemented. We got the platform strong and it's ready, and we have a good kind of base to go do acquisitions. So years 2 to 5, we focus on helping management generate new deals, negotiate deals, structure opportunities, and close add-on acquisitions. Oftentimes competitors, adjacencies. Maybe there's another adjacent software that would just be a no-brainer acquisition. Maybe they work through a channel partner or whatever it might be that potentially might be up for sale. And so we help management get a pipeline of targets, negotiate and send out offers and help kind of run the due diligence process and all that kind of stuff years 2 to 5, right? And that's where a lot of the founders or the management that want to stay on and work with us, this is kind of where they get really excited. They want to kind of grow their business inorganically as a faster clip, right? And so let's say like for yourself, Ara, like how hard it is to generate like $100,000 of extra annual recurring revenue, right? Sometimes there's cases where you can actually just buy a competitor and it's actually cheaper and it'll cost you less money to generate that extra $100,000 in revenue than it is, investing it in marketing, sales, R&D, where not to mention that not only will the cost may exceed the value from that 100K contract or whatever, but it's also pretty uncertain too. Like, it's fairly uncertain. Whereas when you're buying a business, kind of roughly exactly what you're getting, right? There's the contracts, customers, employees, and all that kind of stuff. And so we found that M&A and doing like a handful of acquisitions after the platform is pretty much one of the best ways to add value here. And then year 5 comes up. We hire an advisor, a banker to help us represent the business for and put it up for sale, right? And so the business by that point will have grown both a little bit organically, but a lot through acquisition, and kind of integrated it nicely into kind of one larger platform. And we look to kind of sell to either a strategic or a larger PE fund down the line. The idea is, we're in the lower middle market, kind of putting these kind of businesses together. There's a threshold in which where you cross in ARR or EBITDA, where larger private equity funds get interested. So they look at the business and say, oh, wow, now it's big enough for us to get interested. And when that happens, with the hundreds of millions, the $100 million, couple $100 million private equity funds out there, that's when you get a multiple lift, right? And so now you get a little bit more of a competitive process. The business is institutional grade. It has executives that we've brought in. It's got multiple different offerings, either grown organically or through acquisition, and it becomes very attractive for a larger institutional buyer. So that's kind of what happens in the roughly 5-year period after we close a deal.
Yeah, this is fascinating. I guess 2 things. One is, the pricing power. One of the things you kind of kept harping on, and I see the value of it, and something to for me to seriously focus on is pricing power, because that example I think you gave and a few others, like the Seeds candy that Warren Buffett, how much pricing power they had, which is crazy. So I think a lot of people are just scared to kind of increase prices when you can, but obviously there's a risk associated with that. So you should be pretty confident that your product is good enough to withstand that, especially depending on the current climate and type of business. But the second thing is, as you're kind of talking about, your model of selling at year 5, I just think of, sports analogy of, maybe baseball, where, you have how this market looks like to me is, you have companies that that buy companies. I know companies that purchase, companies in the 1,000 ARR, 2,000 ARR. And then you have you go up to the next level. You have Micro Acquire, which focuses on the next level. And then you have someone like yourself that kind of is that next tier. And then you have these bigger PE firms. So it's almost like baseball, where you scout somebody at a really young age, you see that they have talent, and then you kind of help develop them, you put money into them, and then they move up to in baseball, A level or double A or triple A, and then eventually they get to the pros where they get paid the big bucks.
It's a great analogy.
So that's immediately what I think of, which is you're buying this asset that you think is a no-brain. It's like the fat pitch. it's a no-brainer. You put resources into it because it's like, maybe let's just say hypothetically, it's like a 1 or 2 million or $10 million ARR. But then you, with what your playbook, you guys get it to like 50 or whatever it is, 60. And now that next level above is like, hey, I see what you guys are doing. Let me take that off your hands, and you guys get the chips off the table. So yeah, it's just very fascinating. I guess the question there, as you know, you said all that, is I only bring this up because I saw this. I think you posted on Twitter recently that you went to a talk with Mark Leonard from Constellation Software. He's a Canadian company. I think people don't know that, and he's a founder CEO. He's probably one of the most elusive people on the internet, because I think there's like one or two pictures maybe. And he's a super underrated, entrepreneur. Probably has. I'm going to give him the PhD of, like, in the art of patiently buying and holding software companies. And obviously, I know you're a big fan. I'm curious, is he someone you're looking to emulate in terms of like that buy and hold? Because you talked about, because you have maybe, I guess, external investors that, you're promising a certain return, and maybe the exit's the only way to, or the sale of a company you buy in year five's maybe the only way to do it. But is your ideal to eventually be completely buy and hold, or is, selling also something you're going to continue to do? Money can be hard to come by, but here's a $100 opportunity for you. Join my free newsletter for free exclusive content and a free chance to win $100 when I hold special draws. Did I mention that it's free?
Good question. So first I want to say I'm definitely a huge fan of Mark Leonard and Constellation Software. I think he's built a very unique, like once in 100 year type company. I don't think there's anything like Constellation Software out there. Well, there's a few kind of copycats, but I don't think there's
Oh,
any
I want to add
any.
some. I want to add something about Mark Leonard as you try to interrupt. But the other crazy thing, like you said, the once in a lifetime. I think when I talked to somebody there, it's like, I think he's built this over 20 years and like compounded the business by buying and holding these SaaS companies. There is apparently like secretaries there that have worked there since the beginning, that at this point now they still work there, but they're like millionaires on paper because of, like, they got stock and all that. So just a side note, continue.
I mean, they're probably millionaires liquid, right? Because it's public companies, so they
They're probably wealthier than the entrepreneurs that get their companies bought. That you might laugh, but I'm like, it's
yeah.
probably true. I don't even, I'm guessing, that's my guess.
Yeah, and so a couple quick comments on Constellation. I think he's built an incredible company. Honestly, I don't think there'll be like a company like that in another several decades. A lot of copycats, but they'll never kind of come close to the real Constellation Software, in my opinion. There's a few things that fascinate me, but here's what fascinates me about Constellation Software. First and foremost, they built a decentralized acquisition engine, which is incredible to me. So they have like first year, like you get a job at Constellation Software, right? And within a couple of years, you're running your own deals. You're literally finding and closing deals, like allocating capital, right? Like that's a pretty insane thing. Like a lot of people kind of compare um Mark Leonard and Constellation to like Buffett or Berkshire, but in my opinion, it's way different. Like at Berkshire, Buffett, Munger, and like his core staff, I forgot what their names are. Like they have a lieutenant, a couple lieutenants there and whatnot. All it's centralized capital allocation, right? They're pretty much making all the decisions here. At Constellation Software, you got like second and third year M&A folks with not much experience prior making acquisition decisions, right? All across the world, not just in Canada, in Europe, in Asia, or maybe not, I can't remember if it was Asia, but definitely Africa, Europe, South America, and North America, and Australia too, that are on the ground buying up these companies that are relatively small, right? I mean, they're usually, I heard that is the average transaction size, like 6, 7, 8 mil ARR, right? And so that's incredible. I honestly cannot think of another business that's even remotely like that in any other industry where there's like folks ground level acquiring like companies. Like it's quite just like I can't drive the point home enough how unique Constellation Software is, because that's a very difficult task to train someone that's just not that's someone in experience. And so the machine, the system, the machine, the capital allocation machine that Mark Leonard and other folks at Constellation Software has built, very, very unique. very commendable. Am I trying to emulate Constellation Software? The answer to that is definitely no, right? Like I draw a lot of inspiration from them, and I've read, all of Mark Leonard's letters. If you haven't read them, by the way, highly recommend them. Great approach to kind of capital allocation, measuring performance, and a bunch of other kind of interesting tidbits around business and investing and allocating capital. So definitely recommend them. They're inspiration for us. We play a lot in the same arenas, but we just have completely different strategies, right? Like we are private equity, we have to buy businesses with the intent on selling, improving and selling, right? And I know private equity kind of gets a bad rap over like, they're just like buying businesses and like, putting like a lick of paint on the front door and then just kind of flipping it to the next investors. I don't think it's like that at all. There's probably some players that are out there, but they just won't last, right? I mean, like the real value, private equity needs to create real value in order to make money, especially in this day and age. It's ruthlessly competitive. Um, yeah, so I think the majority of businesses that are purchased by private equity, especially in the lower middle market, right? Like, the under $100 million in transaction size, you need to add serious value. You need to actually improve the business. You need to actually put the right people in. You need to actually put the right initiatives in place and build a formidable enterprise to actually make money in this business. And so we defer in that. Yeah, we have overlap in terms of the types of businesses we buy. We look at a lot of vertical software, a lot of sticky software. In fact, one of our portfolio companies actually operates in a vertical that Constellation Software operates in as well. And so like it's there's a bit of overlap there, but in terms of strategy and kind of how we make money versus how they make money, they're very, very, very different. But some of the other kind of people that I draw inspiration from as well, like obviously, the ones that we've already mentioned, like Buffett and Munger, huge obviously inspirations. I've read all of there's a collection of essays or their annual letters that's it's in a book format. Definitely recommend anyone reading that. It's a great kind of mini MBA to business and investing. You may have seen me speak about him on my blog, but Nick Howley at TransDime. I think he's incredible operator. The way he kind of approaches like costs and running an aerospace manufacturing business it's incredible. I think when I kind of did deep dive into TransDime, and there's some really good podcasts out there with Will Thorndike and Nick Howley. Highly recommend. There's an example of just private equity at its best, right? Like it was TransDime was born in lower middle market private equity, right? It was like I think tens of millions of dollars of AV when it first kind of put together. It changed hands between three other private equity owners. Now it's public, and every single owner made a ton of money. Every private equity owner, all the employees, and each iteration of the business just got better and better and better. And today it's a strong conglomerate of aerospace manufacturing enterprises. And so there's an example right there, right, where private equity created a ton of value in that space for investors and employees and customers as well. Some other kind of inspirations I draw from as well. Definitely a couple low key ones that people may not have heard of, like Kirk Kerkorian. I discovered him by reading the book The Gambler, which I definitely recommend. It's an incredible story. I love his risk tolerance, his high conviction bets. He was in the casino and Hollywood business. He started his career in kind of aerospace as well. And it's just in kind of reading the book, like there's a lot of things he did through his career that you just know that he was just a great person. Like he was highly charitable and very kind to all his people that he worked with and all that kind of stuff. So definitely Kirk Kerkorian serves as an inspiration. And the last kind of inspiration I'll add here is someone named Reginald Lewis. And there's a book called Why Should White Guys Have All the Fun? And it's a really inspiring book. It's about Reginald Lewis was probably the first African American to enter private equity. And this was in the 80s, where this absolutely unheard of. It was a heyday of private equity, right? You have like KKR and Blackstone kind of doing massive deals. And you have Reginald Lewis, who's kind of like a one-man shop, bootstrapping deals. And he did a $1 billion acquisition of Beatrice, which was like a food company. And unfortunately, he passed away from brain cancer in his 50s, I believe. And if that hadn't happened, he'd be an absolute titan of private equity, and he would just definitely be probably one of the wealthiest African Americans today. So those are kind of some of my inspirations there, that beyond kind of Mark Leonard too, that have a pretty big role in shaping my kind of philosophies and business worldviews.
That's great. So I guess we talked a lot about your business and kind of all that, but what about yourself personally? I mean, maybe it's tied to your business, but where do you see yourself in the next, few years? Like, do you see yourself just continuing to buy businesses, or are there other avenues of interest that you want to pursue as well?
Yeah, next 3 years, it's I try to review what I'm doing every year, at least like annually, like kind of look back and say, hey, am I enjoying what I'm doing? Do I like what I'm doing? Am I gonna keep doing it for the next year? And so the last couple of years, it's been absolutely right. And so every time I kind of look at all the things I'm involved with in terms of Atlasview and acquiring businesses and all that kind of stuff, the answer to that is definitely if I can keep doing what I'm doing right now for the next 3 years, I'd probably be thrilled, more than happy. It's the idea is I want to grow the portfolio, right? We want to get to maybe like 4, 5, 6 businesses in the next 3 years. Like when I say 4, 5, like 4, 5, 6 new platforms, right? And so have a nice portfolio kind of built out, work more and more closely with our portfolio companies to drive value. And then, maybe in the long-term scheme of things, we'll see. Like, I think like I've considered maybe even doing like a holding company where we have a bit more of a buy and hold strategy, as you mentioned. Being a big fan of Mark Leonard and also Buffett and Munger, I see the distinct advantages of having permanent capital in your investment strategy, right? When you don't have to return capital in a finite period of time, you could do a lot of great things in that over a longer period of time. And so maybe that might be something I consider after like the 3, 4, 5 year mark. Would want to be able to post some exits on the board, post a good track record with the current portfolio companies, and hopefully the new ones that we acquire the next couple of years or so. And so to kind of long story short, to answer your questions, where do you see yourself in 3 years? Pretty much doing the exact same thing I'm doing now, is meeting more founders, acquiring more companies, making good deals, and kind of creating value in the businesses that I own.
And you also forgot to mention, I think something people would like to hear. You ideally maybe want to live somewhere warm out of the winter months in Canada, right?
Yeah, as you know, it's kind of hard to do that with kids and stuff. And like my wife and I talk about that yeah, all the time. Like every winter we're like, damn, we should have gone to Florida or Texas or California or something. And yeah, I mean, I think that would be a nice goal. It's a bit tough too. I mean, sure, as you can probably relate to, our like all your friends and family are here, and having to kind of pick up and move and come back, it's a bit tricky. So, but yeah, we'll see.
If you had a chance to go in a time machine and visit 16-year-old Jay, what would you tell him?
That's a good question. I would tell him basically life goes by fast. Enjoy every minute of it. Like, not to get too caught up in where you might end up or whatever it might be. Like, I think like your 20s goes by so fast, and it's like a highlight of your career. And by the way, I had a great time in my 20s and really enjoyed it. And just kind of to like a confirmation saying, hey, make sure you really, really enjoy your 20s, make as many friends and relationships as possible. One of the things they don't tell you when you're younger is like, through high school and through university, after university finishes, it gets harder and harder to make new friends. And so keep the friends that you're really close with at university, even after you graduate and what have you, because, as you get into adulthood and, get married and have kids, it gets just harder and harder to make new friends. And so try to get as, many high quality relationships built out in university as possible, and keep in touch with them, check up on them on a regular basis. What else would I say? Definitely buy Bitcoin when as early as you can, and that's basically it, really. Yeah.
I love it. I love that last piece of advice. I read this a really good article called The Tail's End. I might be messing up the title, but the premise of it is mathematically, most people would have seen like their parents or friends. They break down the percentages, and it's kind of like depressing where it's like, oh, you would have seen your parents for 80% of your life. After the age of 30, you're going to see them, out of the hours in a day, you'll see them maybe 10 to 20%. So it's kind of like based on like you visiting them once every 2 or 3 months or once a month. I forgot the number. So like I'm a very mathematically inclined person. So for me, when I read that, I was like, oh, is this math? I got to just increase the frequency I see them. It might not all be like quality interactions, but like I think quality comes from quantity. So
Yes.
yeah, I love that advice that you mentioned. So how about looking forward in terms of your personal legacy? How do you want to be remembered by your friends and family?
Oh man, I never thought. I mean, I feel like I'm too young to think about that. Truthfully, it's kind of a morbid question. It's kind of like, hey, after you die and you're gone forever, how do you want to be remembered, kind of thing, right? Like, so I haven't really thought too much about that. I don't know if I really cared either. Like, my kind of goal is I want to enjoy as much as my life as I'm still here, right? As opposed to worrying too much about what are people gonna think of me after I die. And so, while I'm here, I try to be as nice as possible to everyone. Try to have a good time, enjoy, try to have, make great memories with family, friends, wife, daughter, parents, and try to spend as much time with them as possible, and and work as hard as possible too, right? I mean, like it's work is a pretty large portion of your life, and so it should be enjoyable, and you should be working with people that you enjoy with, and so I try to have fun while actually building businesses. So yeah, that's kind of like my answer. I know it's kind of like a non-answer, but I haven't really put too much thought in my legacy, and nor do I really care. I'm just kind of focused on enjoying the now and really kind of living life to the fullest.
Yeah, I know. I definitely realize it can come off as a morbid question. I guess why I love this question is I read this book called The Five People You Meet in Heaven, and it's like a fiction book, but it just made me, and now especially as a parent, I guess it's like I think about it more, even though obviously, like you said, we're quite like relatively quite young. I guess it just like for me, it's not like I'm thinking about legacy, but it's like, oh, if I were to like die tomorrow, like
Yeah,
what would people say about me? And it's not like I care about that, but it's like, am I living the right way that I want to live? For the most important people in my life.
yeah,
So it's like for me, it's like I hope I'm like an MVP in terms of like certain things. I hope I'm a great parent. I hope I'm
yeah,
like a father. I hope I'm a good husband. I hope I'm a good son, brother, friend. And like maybe those are the five things. I don't know, but like obviously it's very broad. But I feel
yeah,
like it's just kind of a great reinforcement at times when I get annoyed at things or annoyed at people, or maybe I'm spending too much time on like work or something that I shouldn't be, that I'm like, is this a good waste? Is this a good spending of my time? Like, is this something that I'd be proud of? Or like if I died tomorrow, like I'd be like, I should be doing this now. So that's all it is. But no, I definitely get your answer as well. I think your answer makes sense. Like, why think too much about death when like we're living, right? So it's
yeah.
yeah. Now we're gonna kind of, it's a good segue into the last part of the segment, podcast. It's a segment I like to call Creator Confessions. It's a speed run. I'm gonna basically say a bunch of statements, and you're gonna tell me the first thing that pops to mind. Ready, Jay?
Okay, I'm ready.
Favorite Tamil food?
Kotroti.
Something that scares you.
Um, I don't know.
Now it's gonna be my mission to find something that scares you.
You know what? Nothing really pops up. I'm not trying to say I'm fearless. I'm scared of a lot of things, but I don't know. I'm kind of drawing blanks here.
No worries.
Can we skip that one?
Yeah, yeah. What's an insecurity that you have?
Insecurity that I have. That's another tough one. Jeez, these are these fast questions are quick. Okay, I'll say that an insecurity is not spending enough time with my family, both my immediate family, and also my parents as well. Right. So sometimes I'm kind of thinking like, oh shit, like maybe I should be spending way more time. Just like you mentioned, right? Like less on business, more on family, and then I'll regret it once it's too late. So that's definitely an insecurity that keeps me up at night sometimes.
Favorite TV show you're watching?
Oh, Yellowstone.
Yeah, great show. Love it. If you're an entrepreneur, you like that. It's like and family. A place you're itching to travel to.
Ooh, that's a good one too. I think South Africa. Yeah, South Africa.
Fellow Tamil creator you want to give a shout out to.
Can I give a shout out to you?
I'll take it. I'll take it. Favorite childhood memory.
Favorite childhood memory. Okay, kind of most memorable moments, I think, is when we kind of first moved to Canada, like many other kind of Tamil immigrants, we're living in this like tiny, like 1 bedroom apartment, and it was like above this like kind of sketchy neighborhood. And I remember and my dad was kind of working in a business, a piece of shop right underneath. And my dad had purchased he finally kind of saved up enough money, put a down payment and purchased like a large house. And I remember when we moved into that house, it felt like it was so big compared to the amount of room that we had. in our tiny one bedroom, like two bedroom, like little rinky dink shack. It felt like a castle. And I remember like just thinking, holy shit, this is so massive. What are we gonna do with all this space? And like I'll just never forget that like feeling of just like crazy. It just felt like ultra luxury compared to what we were used to.
You know, it's crazy. Like I remember something like that when we moved from like a very small space to a bigger space where I think we each of me and my siblings had our own room. Even though the space was great, something I realized over time later, like now in my adulthood, is as we got more space, the siblings got less closer in a way because with proximity, you know, like when you're kind
Yeah.
of forced proximity, like, you know, I think at one point all four of us shared a room.
Yep.
We
Yep.
shared
Same
like
with
so
us.
we like chatted so much, and like, you know, when you have your own room, your own life, you kind of like start focusing on that more. It's
Yeah.
just like something as you're saying that, like that's just something that I always think about is the I remember having your own room was awesome because you hated sharing. Like it wasn't kind of annoying sharing all the time, but
Yeah.
there was something to like when I live in a condo, so it's like smaller space. So like I realized that that's one of the benefits, even though the less space is not ideal. But anyways, yeah, just a random thought. Something that you like to do for fun outside of work.
Definitely travel. Both my wife and myself, before we had our daughter, and also after now too, we travel different type of travel now, more kind of family oriented travel. But before, like my wife and I traveled to a bunch of different exotic places around the world and stuff like that. So yeah, travel is definitely up there.
Favorite movie of all time.
Ooh, that's a good one. I'd probably say Casino. Robert,
Mm,
not Robert, yeah, Robert De Niro,
yeah.
right? Martin Scorsese. Not only is the movie really really good, it's just action packed, and I just love it from start to finish. The book by Nicholas Pileggi is just equally good. Like I literally read it in like one sitting, and so yeah, definitely Casino.
A purchase that you've made recently in the last few years that you've splurged on, but you have no regret about it.
I'm just like looking around my room right now, see if anything. Yeah, honestly, nothing's coming up. I'm drawing blanks on this one.
I
Give,
was
give
gonna
me.
say one of your two businesses, but maybe not.
There you go. There's my answer right there.
A pet peeve of yours.
I think a pet peeve is definitely tardiness. I do get annoyed when people kind of show up late to meetings and stuff like that, especially if it's a scheduled meeting and people kind of show up late without giving any heads up or anything like that. So that's a pet peeve.
If you knew that you were gonna die tomorrow, a regret that you would have.
Oh man, this is tying in the point from earlier. Probably
Yeah.
that I did spend more time with my parents and my yeah, mostly my parents, but some my family too, like my wife and daughter and stuff like that. So it's definitely time spent. I think would be probably a massive regret.
A book you've read or a podcast you've listened to that's had an impact on you.
Book or podcast. Okay, well, I'll give you the most memorable podcast probably listened to the past year is the one with Nick Howley, TransDigm CEO, on Will Thorndike. It's probably one of the best podcasts I've ever listened to. Huge impact on kind of business philosophy and kind of how I approach different things. Book. Okay, I got one for you. This one's actually really good. The best book I read this year that had a big impact on kind of everything is Lessons from the Titans. And it's a book that profiles like I think like 10 different companies. Funny enough, TransDigm being one of them. And these are all really old companies, right? That have been around for like decades. And it's just it's such a great book on like kind of like their failures, their successes, how they've kind of iterated over time, and it just kind of shows you there's just so much gold nuggets in that book. That one had definitely the most impactful book I read this year.
What's a belief, behavior, or habit that's improved your life?
Go definitely. I'll say two things. Fasting in the morning, so I don't. I generally kind of have a fast window and don't eat until like 12 or 1 p.m. It kind of improves my focus in the mornings. I get a lot done. In fact, I could probably finish like 80% of my day by the time like noon comes, potentially even 90%. And I guess another habit is just going to the gym regularly, right? And I've been going to the gym on like a regular basis, at least like 3, 4, 5 times a week since I was like a teenager, basically like 18, 19. So hopefully I could continue that as I get older, for as long as possible.
My wife has been on me to she's a physiotherapist and like she goes to the gym like 5 6 days a week. I go like once. I'm trying to get up to like 5 days eventually. I play sports and walk. I'm not a gym person, but
Yeah.
I think the value of going to the gym is important, especially as you get older, like strength, muscle, like just strength training will be important. So it's a good habit. And the final question, I guess, I should have actually asked this earlier because it would have been useful, like early in the conversation for folks. But if you're a business owner looking to sell your business, what's a piece of, or like, what's some advice you would give to them because they should be aware of going into the process or just what to expect from the process?
Yeah, good question. So, a few things I'd say is definitely do a little bit of homework, right? You kind of want to understand where your business might be worth. I find a lot of times business owners might think their business is worth more than what the market would value it. And it's not their fault at all because, you're in the business, you see everything, you're kind of, you have an affinity for it, and it's kind of like your favorite child. You're gonna, obviously think way more highly of your business than other outsiders might. And so definitely get a understanding of expectations on valuations. It's a long process. If you want to sell your business, it's like a year long process, right? So you got to find someone. And actually, before I get into that, I'll say, and this is a little bit of shooting myself in the foot here, but I'll say it regardless because I genuinely want the best outcome for all founders and business owners, and whether it's in the best interests of Atlasview or not. But truthfully, I think you should work with an advisor. I think if you've never done a transaction before in your life, never gone through the M&A process, you definitely should work with like a broker or like a lower middle market investment banker. You should do your due diligence on them, see what other types of companies they sold for what multiples. They'll give you all that information. And so definitely work with an advisor. A good advisor is worth their weight in gold. And so do a bit of homework and do a bit of legwork here to get good representation on the advisory side. The last point is it takes a while to sell your business, right? So make sure you have all your documentation ready because a good advisor will ask you for things like, your financials, your contracts, document everything, right? Like if it's not documented, it just doesn't exist, right? It's hard to DD it, right? Like if you have agreements with suppliers or customers, like get it documented, right? Like have an annual renewal or whatever, biannual, whatever it might be. The more documents you can kind of compile in an organized manner, the easier it will be to sell your company, right? And so have everything kind of documented, prepared in a an organized manner, and get ready for a year-long process, right? Because like just do the math here, right? So in order to kind of get the whole DD, you contact a bank, you do you research a few different brokers, you find one you like. They're going to do DD on you because they're going to represent you, and they're going to they need to make sure that you have all your materials ready. Ask for your financials, tax returns, documents, whatever. That process might take up to a couple months, right? I mean, sometimes it might even take 3 months, right? Like I've seen, depending on how clean your books are and how clean everything is. Oh, that's another thing. Keep your books very clean. Hire a CPA to do your kind of your financials, even if there's no audit or review or anything like that. Just have it CPA prepared, because it'll come in handy when you go actually sell your business, having clean books here, because that's pretty much one of the, especially in the lower middle market, that's probably got to be one of like the biggest deal killers. Is like if you don't know what your revenue and profit is, how are you supposed to communicate that to a potential buyer, right? So it might take 2-3 months to get you out to a broker to get you out to market. From there, you're going to talk to a bunch of different sellers. A good broker will line up, several conversations, get you a bunch of offers, then you sign sign an offer, right? That process might take like 2-3 months, right? So now you're looking at a total of like 6 months. And the buyer is going to have at least, another 60 days to 90 days to actually perform deeper due diligence, check all your documents, put together the financing, whatever it might be, close a deal. Now you're basically up to like 9 months to potentially a year, right? So it's not something that you can do in a pinch, right? You can't just go like, oh, I'm gonna sell my company and boom, it's sold tomorrow. It's not like a piece of real estate where you list it on, MLSC or whatever it's called, and or MLS, sorry, and sell it within like 30 days or something. It's going to take a year. It's going to take a solid you should carve out a year to sell your business in order to get the outcome that you'd like. And so those are some of the things I'd probably advise. And by the way, if any business owners are listening to this, especially if you're in software or some sort of tech-enabled business, you can always feel free to reach out to me. Ara, you and I chat all the time about this, and I'm more than happy to talk with any other founder about potentially selling the business, a bit of strategy, finance, M&A, whatever it might be. Always feel free to reach out. I'm more than happy to have a conversation and help.
Awesome. Well, thank you, Jay. That's like a good way to end off the podcast. I mean, appreciate you jumping on. This is a great episode, lots of gold nuggets, especially for entrepreneurs and especially for folks that as they, think about eventually the day they want to sell or, just how to think about it. So appreciate that, Jay. Thanks for jumping on. And, for the audience that's listening, appreciate you guys for listening as always.
Appreciate you having me, Ara. This was a great pleasure.